First, let me thank ABA for organizing this fantastic event here after a long time and inviting all of us for this event. I would like to talk a little bit more about my esteemed panelists because we have got a fantastic team here. We have two early stage investors, that Ashwani and Vinayak. Both are very specialized lawyers in that venture capital and private equity fields. And we also have Aparajita. She's into the late stage deals, and she's also a finance person and is on the board of that various companies. And we have that Rakesh. He's an old man here that he represents that founders and that with more than 20 years of experience in that various that corporate that sectors. What I'm trying to say here that we have a mix of group here. We have early stage investors, we have late stage investors, we have the founders group here. Now let me just come to the theme what we have it here. We're talking about that investors and the founders' rights in the private equity and venture capital transactions. And shifting that stage here. So that you know that in that investments in India grew in a very rapid pace in 2021. And this 2021, it's almost 2.38x of that in compared to the 2020. The investments grew almost 2.3x compared to the 2020. And most of these transactions were in that SaaS companies and healthcare tech companies and fintech and various other sectors. And predominantly that private equity and venture capital funds, they invested more than 75% into these various sectors apart from this M&A. We are here now, try to see in the shifting sands, we're trying to address here that how these rights of the investors and that the founders have evolved over a period of time. When we talk about it in that early 20s or late 90s, how the investors were looking at these particular transactions and what was the mindset of that investors at point of time. How was the negotiation points actually we were seeing at that point of time and what we see at this point of time. And this is a point which we are trying to address it here. And because there are some significant actually changes which you could always see that one because we all started the career in that late 90s. And at that point of time, it was more like a give or take attitude, and it was more like an investor's market. And the founders had less control at that point of time in terms of the negotiations of that any of their contracts. But when we talk about in 2021, situation has changed a lot. 2021, it became actually more standardized in terms of that India became more matured market and moving towards a lot of terms actually that Anil are here that you could see that you started moving towards that NVCA documents and started approaching certain terms. And most of that investors from the Silicon Valley also started adopting that NVCA terms into that Indian market here. And which is a very welcome move to that ecosystem actually, which started giving a lot of powers to the founders to negotiate. And the control is actually still with the founders in terms of negotiating various, the rights of that founders in these documents. And India actually that, that in 2021 we produced almost, that by that time we reached around 41 or 42 that unicorns, if my rights numbers are correct. But we saw some downturn in 2022 due to various macroeconomic reasons, geopolitical and, other, crypto crash. But still, we are still in a good shape. India actually still attracting a lot of that foreign investments. With that note, I would just like to pass it over to my team here and to talk a little bit about this theme from their perspective. And from that, after that, we will start into that Q&A. In the Q&A, we are structuring more in a way that I will ask more about that early stage transactions and how the rights have evolved at that early stage with Vinayak and Ashwani. And the late stage, I would be asking to that Aparajita. And the founder side, I would be checking with that Rakesh. Over to you, Aparajita. But can I just request you to start?
Thanks, Vinod. Okay, so I represent a firm, CX. Just to give a little background about what we do. We are a mid-market firm, And we invest in companies which have a fairly mature cycle, around 50 to 500 million EV side. So of course, I'll have a little different viewpoint, and that largely comes from where we are at this stage. Over a period of time, private equity, not the VC, but the private equity has been a very stable and a mature asset class. Also, the number of transactions, and that I was discussing with Rakesh, how many transactions do you do? Every firm would be approximately, depending on whatever size they do, not more than 3 to 4 transactions. Also, the availability of many companies, they haven't reached to that stage. The subset market is very low. So, in a way, our market was small, and with this VC funding that has gone, and with the emergence of so many unicorns and so many companies that have matured, our market would also eventually move, and there'll be far more liquidity. But what we saw, what we were seeing in the market, what Vinod was talking about 2021, we possibly saw it in early 2009-10, where, of course, the risk was from the maturity of the asset class that we were looking at. And the risk largely came from that, there was emerging, we're in emerging market, and emerging market, the returns and the risk profile is perceived to be much higher. So therefore, our negotiations were also as such. Our negotiations were largely to have more downside protect, indemnities, things on, the diligences were very extensive, exit options, even options like having buybacks from the promoters, how would they fund that buyback, clawback on the shares, putting those shares in escrow to enable a drag on the promoters' shares. So this was largely that was there, but over a period of time, now in the last 2 to 3 years, I think there is a level of understanding which is far better. Now I don't see many transactions where you will see a downside protect or there is an upside sharing happening. It's very tough, and I think SEBI's also taken a very stringent regulations that they've evolved around that. So there is a very positive shift. I think there is much more stability, and I think that stability would now be lent towards the VC market, and there will be a shift in the mid-market segment also. And the buyout market, which is currently very dry, buyout markets are, businesses which have, say, 1,000 to 1,500 crores kind of a revenue which are very profitable. That segment will also evolve. So I think it's a very good shift that we will see. And as the public market get more stable, because that's where your exit options are, as larger companies will be looking at acquiring businesses in India, I think this should mature sooner.
Vinayak.
Thanks, Vinod. So I'm Vinayak. I am part of the legal team at Lightspeed India. We are more known to be an early stage investor. Of late, in past 2-3 years, we've started doing growth rounds in India, Southeast Asia, and companies in US which have their substance and business in India. These are the key areas that we focus on. I started my career as a M&A lawyer, moved into private equity, and like for good 8-9 years, I have done venture, which also became my forte. So I have seen the market in all these 3 stages. More than 3 years back, I used to be more of a founder counsel, so I used to be representing mainly founders. So I have seen how founders think about an investment deal, how they approach investors, what philosophy they have when they go out to raise money. And I've also seen how investors would like to make a deal. So I bring that perspective, and that's something that we'll be discussing here during this discussion. One key thing that I wanted this panel to touch upon and that we have discussed is how in early stage, many times we are optimizing for rights for either party, which may not be very material, and ultimately all that is written on the paper is bound to change in future stages when the company does well. If the company does not do well, we have other problems to solve for. So that's something that we'll be discussing today.
Rakesh.
Let me give the perspective of corporate and the founder on this aspect. I guess things have evolved. Actually, there was a different world pre-20 as we compare to the COVID time. And it has taught us many positions and situations where people have been able to turn around such challenges as an opportunity and created space for themselves and build back business with resilience. I think those are the things that the investors have liked in their investments and their portfolio. I would say that the pre-20 situation is no more as relevant as we compare an investment strategy today. Investors are looking at profitability as one of the key points before they are writing a check. Personally, actually, I feel that, and I can share that we almost started a journey right around the COVID time for the same. But it was so unfortunate that the business went down significantly because of COVID. There was no travel, no tourism. Everything happened like this. But the learning from there is that how do you actually bind a management team back to still work like a startup mode. The day zero is still the year 7. The day zero is still the year 10 today. And still work like that. If you look at the investor's perspective, if a company is able to demonstrate that kind of camaraderie when delivering both operating and financial result, it will be like, for them, like a gold mine. We will deliver, how we'll deliver, or any company will deliver is always a question mark in future. But that's the key shifting trend that I would say is that from a revenue-based, multiple of revenue-based calculation for an investment strategy to look at a robust business model which will deliver profit on a more foreseeable future. So I was actually talking to one very close friend of from top 5 law firms in the world, and he did a big IPO. And I asked him, what's your experience? And I'll not quote the company, I'll not quote the counsel, but he said, I don't know if my grandchildren will see the profits in this company, but he ran that IPO. I don't think that is going to happen anymore. In the current times, in the last 1 year, how the tech stocks have actually behaved, I feel that the investors are super conscious about building the right strategy, especially on the model they're going to bank on, the people they're going to bank on, because they are carrying the character of the organization, the business model, the opportunity the market creates for them, and take it along while performing and delivering profits. That's the most important trend, I would say. We'll talk about the founder rights versus the board performance versus the shareholders' intervention in this whole process of negotiations of an investment deal, maybe in the next few minutes, but over to Ashwani.
Thanks, Vinod, and thanks, Rakesh. Hi, everyone. I'm Ashwani, part of the legal team at Sequoia Capital. We primarily focus on investments in India, Southeast Asia, and MENA region. Very interesting topic, and I started working on venture capital, private equity investments roughly 11, 12 years back. And since then, I completely agree with Vinod, the overall ecosystem has changed significantly. And the balance, I won't say it has shifted in favor of the founders, but to a large extent, the way rights are structured now, is still like a win-win situation for the investors as well as the founders. Now, we can talk about multiple rights here if we double click, but talking about some broader buckets, economic rights like liquidation preference, investors expecting fixed returns, very high IRR. All those things have changed. Now the market practice has simply moved to a 1x trade. Like you just want your capital back, or you're focusing more or relying more on the performance of the company rather than structuring all these deals as debt investments, not a fixed return deals anymore. Something similar, anti-dilution, right? Like all these fancy terms, everyone thinks, or earlier at least we used to see ratchet transactions, right? Now everything has changed to a broad-based weighted average mechanism. Governance rights as well. Like investors are very much comfortable passing on or rather leaving most of the operations to the founders or to the board. Founders retaining board majority for a very long time. That's common now. I don't think, at least from a VC perspective, non-controlled deals, no investor is keen on taking control of the board. So operations are left over with the founders. Even in terms of their exposure, like the reps and warranties they are supposed to offer, the indemnity obligation they have. I think in the last 10 odd years, their exposure has gone down significantly. Early stage deals, it's common not to have indemnity from founders. Even if they have to provide warranties and all, they're kept very minimal. Growth stage, obviously, like things change and market works very, very differently there. But overall, I think Indian VC ecosystem, private equity ecosystem has matured significantly. A lot of guidance, I think, has been taken from NVCA documents since we see like US structured deals, Singapore deals, even MENA region. So we see that flavor, spreading across the geos, and India has adopted, some of those practices really well.
Thanks, Ashwani. Let me come to you first, Ashwani, since you have talked about liquidation preference and governance. So 20 years ago, Ashwani, that when we have started this, our career, we had seen that the investors were asking 2x LP protection, 3x LP protection, and LP protection with the participation right. And participations would fall away at certain point of time. And, a lot of that very onerous that, the liquidation preferences clauses that, we had seen that in the past. But recently, I will say somewhere in the 2015-16 onwards, that we started seeing that investors that taking out 1x or pro rata, that LP protections.
Yes.
And you don't believe to that certain extent, at Accel, I have gone ahead and changed my old document and removed my participation preference and removed that, that higher LP clauses and changed to that 1x or a pro rata at some point of time. I wanted to ask you, Ashwani, here, since you also talked about the governance, and yesterday I heard that Mohit talked really well about that governance rights at that early stage companies. Do you think that trend is changing towards putting more governance in place instead of that negotiating too much about that LP? Or you think that LP is still critical for us, that no compromise on LP, but I'll also put on that governance? Any thoughts on that? If you can just throw some light, would be great.
Yeah. See, as a clause, liquidation preference clause is important. But looking at that clause as a fixed revenue construct, I think that's history now. And again, I think something similar to what you mentioned, even we restructured some of our old documents, changed, fixed returns, and they were like IRR constructs. Obviously, law also helped, with rather force us to change some of those. But I think the ecosystem was prepared for it. Investors were very much aligned. This is not the way we want to invest. And ultimately, you are relying more on the founder, his performance, his idea, and his ability to make a business out of all this. If a startup, to be honest, if you have these kind of, I won't say draconian, but say negative clauses, ultimately this shows lack of faith in the company, the business, the founder. The ecosystem, as I said, has evolved from that side, right? From that perspective. Now the reliance is more on the founder's abilities with limited guidance from the investors. Now there's no intent to control or seek control of the company, the operations. Founders, to a large extent, I won't say have a free hand, but they have flexibility to take most of the day-to-day operational matters. On the critical matters, as you rightly said, governance, like affirmative voting rights or your board seats, observer seats, all those rights are what we rely on instead of, like having a sword on the company, the founder, that they have to return certain multiple to us over a period of time. Business grows, the company does well, and your LP or your investment amount is protected. And guidance, as I said, in the form of limited guidance in the form of our governance rights. Critical rights are covered under affirmative voting matters. Board seat is primarily seen as a tool to guide the company, the founder, the board, instead of seeking control.
Okay, thank you, Ashwani. Aparajita, I'm coming to you on this same topic because that you make a lot of that late stage investments and Ashwani makes that early stage investments. But when it comes to the late stage investment, we used to see a trend that, that asking IRR right at those days, I am talking about that early 20s, people were asking, we want to have 25% IRR, 35% IRR, most of the PE funds at that point of time. But do you still see that IRR concept in the documents, or you also you like to have some kind of down round protections now in the document?
So yeah, I think 10 years back, downside protect was a very valid clause. But what it used to lead to also a negotiation on upside. Share the upside with us. So that used to be a very perverse incentive, because then till the time the upside used to be at a X% of IRR. And if that wasn't reached, the exit discussion wouldn't start. And we are and funds of this size usually have a horizon of 3 to 5 years, whereas venture capitalists can go up to 10 years. One was that. The second thing on how I look at this is the general principle is absolutely right, what Ashwani just mentioned. But in two cases, it becomes a little more important. One is when there is a very aggressive valuation being negotiated. And aggressive valuations are being negotiated, and the investors are saying, okay, I mean, it's good, it looks good, but am I going to make that return at that kind of exit? So at that point of time, I think it depends upon, it's also to test the founder's confidence that can you really bring us X kind of a return with the kind of valuation that you're demanding right now. I think one is that I've seen where it becomes a very important play. The second place where I see is that, especially now I do technology and some of them are Series B, Series C investments. There I see that if the company is at a very high cash burn, and you see there is a dried out of a liquidity. That's what you're seeing in the new tech deals. So will the company survive or not? So at least do I get, so if at all there is some cash coming in, can I get my money back? So I think generally, of course, this is a very normalized situation, but whenever there is a very volatility in terms of a liquidity crunch, or too much volatility, or too much boom going in them, then I think this clause again becomes very relevant.
Okay, before I let you go, Aparajita, one more question on this topic. Since you have that good finance background, I want to come to you on that anti-dilution protections. So in the full ratchet, we were seeing earlier that full ratchet anti-dilution protections in 20s. That has been changed to now to broad-based anti-dilution protections. But off late, in the late-stage deals, when I see it in my portfolios, most of the late-stage investors are, due to these various that market conditions, people are not willing to fix a valuation at this stage. So they're not very sure actually how this market actually within what direction it would go. So people are asking basically either you decide the valuation at a later stage and I would put the money right now and give me 20% discounts to the next round or 25% discounts to the next round, or that adjust my conversion ratio based on certain milestones of the company, whether it's an revenue multiples or whatever the case. So looks like the trend is actually the changing, that anti-dilutions, that we started with that full ratchet. And then now it's coming to the broad base. Now they're fixing the valuation in a manner that it would be there. Still there would be a broad based after that. How do you see this trend? What is the latest trend in the market now?
Yeah, in fact, very relevant. We just closed one transaction with a convertible round. Now I can put this this convertible thing that's happening, that I'll come at a discount to the next round that's happening. This is actually pretty recent. And it's because of two things that has happened. One, this is again a very clause which is very relevant in case the period of that return of the capital on the monetization is 12 to 18 months. By that I mean that if I put money in the business, that business will be applied in the business, will be applied, and it will start generating a return on a 12 to 18 or at max 24 months. So therefore, I can see my money generating a return. In those cases, we definitely ask for that. So so say supposingly, it's usually at the time of the negotiation when the business they give us the projections, And the projections look as if, next year, FY24, FY25, on forward multiple, they want the return. They want the multiple. At that point of time, of course, we don't know how the business would play out, but the promoter is very confident and they want the valuation on a forward multiple. I think that's the time where we will do a convertible kind of a. The second is that where you've gone, where your portfolio company has gone, has tried getting funding for the next round, and the effort they did, they got a lukewarm response. In that case, existing investors, usually they do a follow-on with this convertible round, so as when new investors come in a way, they're supporting the valuation. So when the new investors come in, they have a reference to what valuation this company will be available at. And the existing investors will have a win-win situation because they would have got it at a discount. So I think these are the 2 or 3 situations. So I think all rights, while we talk about, they're very market dependent. What's happening in the market or what's very specifically happening in the portfolio company. There is either the founder is feeling very exuberant about it, or they feel that it's going to come in another 3 to 4 to 5 years. So whenever I think how imminent the returns are, these convertibles will come to play.
Okay, thanks. So Vinayak, what do you think of it actually? Both of us have seen that many term sheets that the late stage investors were asking us that full ratchet. We don't know about this market. So we want to have full ratchet protection, and we push to keep the full ratchet only period of the 12 months, 18 months. Do you think, are we going back to that old time?
So, very relevant question. In fact, what we have seen, and I had seen full ratchet way many times when I started my work in this segment. And it used to be the norm at that point of time. Only later did things move to a broad-based weighted average. When in 2021, when it was a seller's market, things changed and a lot of new combinations were tried. However, now with the current downturn, I see that in early stage also, many times now the investors want that the round should be pegged to the next round valuation. So most of the times, especially for investors who have not been in India for long and now after 2021, 2020, they want to encash on the India opportunity. You would see that they are coming, but coming with this, with these thoughts about not having full visibility as to how the market would turn out. And in that case, they are seeking to do some kind of a bridge round where they would do an instrument which would, the price conversion would be linked to the next round. Now, this is something which is kind of full ratchet. Because if the round ultimately does not happen, then the converts into the previous round valuation. What we as existing investors have done in that case is not to allow maybe such a full ratchet to come in, or we have advised the companies to at least think of having the period for the next round, next fundraise being extended to not 12 to 24 months, but 36 to 48 months, so that you have enough time to raise that capital.
But you see the full ratchet for a minimum period of time, at least.
I would not say I see it all the time. Maybe in 20% of deals that we are doing, follow-ons, we are seeing full ratchet coming there.
Coming to that,
One
right?
great move that has happened in the anti-dilution protection world is like in 2010-12, used to have provisions saying that promoters would transfer their shares to the investor to make good the loss suffered by the investor. That provision I don't see at all in any term sheet, any document now.
Yes, that has been completely removed now.
Yeah.
Okay, so to your famous topic, Rakesh, I want to talk to you about that reps and warranties of that the promoters. See, 20 years ago, Rakesh, you would have seen that in our when I did the transactions, that more than 50% of that, the transaction document would contain only reps and warranties from the companies. And I have seen that many instances where the founders were signing it without even going through the same. Okay, no disclosure schedule, nothing on that. Okay, but the things have changed dramatically that over a period of time. Now we are moving towards more or less like an NVCA set of that, that practice here, in a sense that some of the founders stopped asking reps and warranties from the founders. So they want only the reps and warranties from that company. But in some cases, I see that it's a mix of that one. Some cases we see that promoters reps and warranties backed by that indemnity. But indemnity is nowadays very limited indemnity still that promoters give. It wouldn't extend to their the personal assets. I wanted to pick your that thoughts on this actually. How have you seen the reps and warranties in your documents? Are you comfortable with giving that the founders reps and warranties, and to what extent you would push back giving reps and warranties by the founders, or would you like to limit that only to that company level reps and warranties?
So first of all, this is a tough one actually because two investors sitting on the both sides. And they're the ones who actually sent those 50 pages document initially.
I hope you read it also.
Yeah, actually, in fact, I made a request to both of them that I hope you read it first. Because it comes from the council and then my council tells me that this is what we have got. So I'll make a very first broad-based comment that I think it is very important for our councils to understand what does the investor ask and what is the company's ask. Most of the time, there is a huge gap in between that. That 50 pages actually is roughly about 15-20 pages if it is the company and the investors are having a talk. But having said that, I'm not discounting anybody's capability or their rights to do things or probably the intent to do things when things go wrong. These are all here to protect an investment, which is absolutely fine. Coming back to the size and the depth and width of the reps and warranties. Should it not be limited to certain fundamental rep and warranty? And think about a startup, right? What does a founder actually bring onto the table? You're actually banking on an idea. What rep is required from him, right? It should be actually a thin one-pager rep and warranty for a startup. If it is a mid-stage to a late-stage company, it could be probably something relating to the company, the operations. Think about it like this. The fundamental warranties about authority, capacity, shares issues, and so on, is always given. Nobody should even question. There should not be any negotiation around that. It should probably solve the time issue for getting the funds into the company to start the operations. And most of the time we talk about these 50 pages of warranty for 3 months, and we forget that our business plan actually got shifted for 3 months, and the valuation actually shifted for 3 months. Coming back to the size and volume of the reps and warranties, we make a mistake of thinking that the founder is running the business, and even if it's going to the stores. If I run a tech hotel platform, I do not know if the hotel partner has complied with the operations of that store. But the rep and warranty in the compliance page actually will talk about everything. That as if I have full control on the business. Can we make it absolutely practical that the rep and warranty actually pertains to sustainability of the business, to justify that business model that you have done and justify that expansion plan for which the investor is banking upon? That's the first point. Are there fundamental issues in the company or for which you are worried about? For example, a key policy related issue, anti-bribery, anti-corruption related issue. There should not be any question. The founder, other way around, should actually just give away those points straight away rather than having a negotiation around it. So I'm more talking about how we actually make it practical between the investor and the founder, and when I say founder and the company, to make it light at the same time practical, to say that you are in charge of an operation, means you are still operating the key licenses that is required for running the business. So rather than making it like an N block, anything under the sun, right, like a boilerplate rep and warranty, it should be very practically drawn, should not compromise on fundamentals of the business, should not compromise on stability and the sustainability of the business. Especially when I'm saying this, I'm more talking about if I've actually drawn my financial plan well, and in that sense, let's say a particular audited 31st accounts I stand by, not only signed by the auditor, but I stand by that and I have made the plan accordingly. Have I proposed a plan keeping in mind that I am expecting certain business licenses and expanding my business basis those licenses? Have I drawn it properly and I have actually given the rep properly for that? And what happens next, for example? If that needs to have a consequence relating to indemnity, what are the challenges that I face? And we talk about a founder doesn't have money. So the question is about either there is a clawback, or the question is whether there is a kind of free shares given to the investors, right? The compensatory shares. These are all matter of negotiation. I would say that there are many things that people talk about, but there are many aspects that we bring onto the table. We write in the contract, but actually I've seen many things are not enforceable.
Yes, I agree with you. Most of the times, if you just, for example, that Rakesh, that 6 months old company, that IP rubs itself would be that 4 or 5 pages.
Absolutely. So the good part is that we have been able to engage with the investor per se, right? You have the practical discussion rather than doing the exchange of the different drafts.
Yeah,
and
but
you are able to.
Sorry, do you see that changing the trend now that in the
Absolutely.
market actually that now that
there is a
investors
very
are more
positive
focusing into the business of that company and seeing the rubs, I mean, narrowing it down to the extent of that, that
I have
business.
seen that.
And you have
There
seen
is a
that.
very
well,
positive
right?
progress
Yeah.
on that.
That's what I'm just trying to say.
Yeah,
That is
there
a
is very
recent
positive.
trend. We also see that we have cut down that rubs to the maximum extent, only which is very necessary.
So earlier, for example, investors, counsels were asking for a 5-year indemnity for the rep that you give, right? I don't think anybody is actually doing that. Are you asking for 100% coverage? It is not anymore the trend. It could be in the range of 10 to 15%. It could be in the range of 12 to 18 months coverage. In fact, I was doing a deal, and similar founder exited. And of course, that's more like an M&A. But now, most of such deals are actually backed by insurance. And the minimum, the deductible part is actually the residual warranties and the indemnity that you're actually providing from your cash. If you have cash, if you have clawback shares, or you have compensatory shares for the investors. It's like
Yeah, I agree with you. See, I don't think the lawyers in this group may not agree. But from the investor's perspective, most of the time we see that it's a very academic point, these RUPS warranties and indemnities. And we don't try to spend too much time on these particular clauses, right, Vinayak?
Yeah, yeah, sure.
But Vinayak still spends some time on that.
I don't.
And I'm just joking.
Actually, in early stages, most of the time, like when we do our first checks, and I was just chatting with Vinod the other day, like for a 5 million, 10 million check, at least if you have a pedigreed investor on your cap table, no one is going to sue you for a breach of warranty. That's not worth the time of the team at the investor's end as well. So I'm kind of more liberal when I talk to my friends. I just ask them, pick up the right investor. If you have the right investor, then don't worry about reps, warranties and indemnities, because no one is going to come after you. You have free hand to run the business the way you want.
I'll just add one more point, actually. By the way, both I have done that discussion with Ashwani and Vinayak, and they've been fantastic on understanding the business that we do. So I had a very, I would say probably easy going on that side, but I'll share the founder's perspective of it. Most of the time, the investors' counsel look at as if it is the investor's ask, and rep and warranty you need to give for protecting my investments, and so on and so forth. But actually, it is more a reputation issue for the founder, right? Whether you are actually breaching a rep and then even having a dispute about an indemnity or no indemnity, it becomes so much of a reputation issue that either you are not going to get a funding in the next stage.
Absolutely. Yeah.
Or probably you're impacting the whole ecosystem of investment in that scenario. So the suggestion to very early stage or probably the new startup community is that do not undermine this aspect of the business, that when you are drawing a document for investment, rep and warranty are not going to be easy thing. Be practical, but be serious about it.
Agree, completely. So I'm coming to you on the same point, Ashwani, but slightly different. I want to pick your brain on this exit scenarios. How do you handle these reps and warranties? Because in early 20s, the concept of that startup was not there much, right? In that corporate setup, founders were controlling that majority of the shares of the time, and investors were having very minority stake. And in the exit scenarios, investors said, my rep would be limited to title to my shares. Indemnity cannot go to that anything beyond that limit. Only I will cap it. But of late, what we see that promoters are very minority shareholders and investors are the majority shareholders in the startup sector. So when it comes to that any strategic sale or any liquidation event, promoters won't be very comfortable to give an reps and warranties for the entire shares of the company. Have you agreed to give that reps and warranties, or and what is the kind of recourses you take it at that point of time?
Yeah, as in, to be fair, like 10, 15 odd years back, there were not as many exit opportunities for VCs. Let's be fair. Now, obviously, we see that happening every now and then, and that's why even the practices have evolved. Still, in most of the cases, we do, end up closing exit transactions with investors only offering fundamental warranties, or offering indemnity only for fundamental warranties. But yes, there are exceptions where promoters' shareholding is either nominal or they are not willing to offer full indemnity for the amount we as investors are receiving. Now, in most of those cases, as Rakesh touched upon, insurance is turning out to be a good option, which used to be very costly 5, 6 years back. Things are slightly better. We all know what at least on day one, we are aware what our financial exposure would be, and then we are done with an insurance. The other options, holdbacks, 5%, 10%, 20%, like it varies from transaction to transaction. Every transaction will have its own dynamics. Certain amount is held back by the buyer for say 12 months. If they are able to see any misrepresentation or breach during that time, they can set off certain amount from that amount, and the remaining amount is received by the investors as well as the founders at a later stage. So yes, there are multiple options available which apply in different situations, different transactions differently. But yes, we have been asked to offer some of these, I would say, the new options or some more protection as compared to just fundamental warranty or indemnity for fundamental warranties.
Thanks, Ashwani. Vinayak, I want to come to you on this voting rights. Those days, since this is at shifting sands, I wanted to see how that voting rights have evolved over a period of time. Because those days that investors were having control over that everything, okay, and affirmative rights would be just a laundry list for the 3-4 pages. But now we are also moving towards that NVCA approach, limited to certain aspects. So it would be limited to just that our protecting our economic rights. We don't much get into that controlling rights, but at a very high level we have it in the controlling rights. What do you see about what's the trend change now? How is it changing now?
Yeah, so I think now with the ecosystem maturing, of course people want to follow what are the best industry practices. Like if you go to US under NVCA documents, there are two types of affirmative voting rights. There would be AVMs at the board level, there will be AVMs at the stockholder level, and the AVMs at the board level would be mainly operational matters. So that's something that I have seen percolating down to India as well. You don't see those laundry list of affirmative voting matters. Like the longest I had seen was a list of 67 items. So now the items would be somewhere between 25 to 30 and not more than that. That too in senior stage companies. In early stage companies, you would not see more than 12, 13 items. At least that's how we have done for our SHAs. There has been a lot of chatter about giving affirmative voting rights to founders, especially in early stages. Because what is happening now is, like when an investor approaches a deal, they approach a deal from a perspective that if it's a Series C deal, I should be able to finish this deal in 2 to 3 weeks and get done with the company, and so that company has funds and can make their business. Whereas multiple times what is happening now is when founders approach these, they are trying to future-proof the shareholders agreement, and therefore they would be negotiating all those things that you would normally see in a Series G or Series F. And the founders would be asking for all reserve matters rights which are available to the investors as well. Personally, for us, we have been against this because in early stages, founders have majority on the board. They are the people running the company. So that's something we have pushed back. In late stage as well, we have only agreed to a limited set of rights. Whilst for investors, it is important that they have say on limited items which impact them economically and which basically help them guide the company in a manner that company is built in a manner that can provide them exit. For founders, similarly, we have been vocal for founders having veto rights for late stage companies when they have, say, come to a 5-10% shareholding. But these should be limited to only matters which affect their economic value and which can tomorrow basically reduce the value of the company.
Correct. Agree. And of late, actually, that we see that none of that individual that investors exercise any consent rights. Everything would be that majority of that preferred holders, right? So coming to you, Rakesh, on that control rights of the founders. And this is also related to the same point that Vinayak just now spoke. So of late, what happened in that when the cap table evolves, actually the founders are becoming very minority shareholders of that company. And most of the time that investors have that right to control through these affirmative rights that, that various matters through the voting system. How the promoters' right to be protected there, actually? So do you see that the promoters are losing control over a period of time and that, that an external CEO is taking over the company and, they would be just a minority shareholders? How that their voting rights in that company can be protected?
Yeah, that's a great point, actually, probably in the whole context of finding the right balance on what is the economic protection that investor is looking at versus how the founder or how probably the company has to run to be able to return the capital that investor has invested. But let me share actually a couple of anecdotal research report about, and I'm talking about because you said that we started from 2000, about 250 companies were researched, and it was found that in the first 3 years, 50% of the founders were not the CEO. In the between third and fourth year, it was like almost like 40% of the founders were not the CEO. And before the company became public or an IPO, roughly about 25% of the company did not have the same founder as the CEO. So what does that mean? That means actually there has been a significant push and pull as far as the shareholders agreement is concerned about rights or disproportionate rights in either side, whether it is the founders or investors, and how to find the right balance. And that actually leads to another Harvard Business study on, you draw on the x-axis, the y-axis, the control, and you lose control the way you go up, and you draw the x-axis for financial gain that you are having. And it is primarily from an investor standpoint if you look at. The more control you have, it is actually in a way you're looking at thinking that you know the business all in, you don't need any advice, you don't need any professional CEO, you don't need any different kind of management and the board and so on and so forth. So that means you are running the show effectively. The research finds that they could be probably the king, but they may not be one who are actually able to build the largest businesses. If you go up, that's a kind of category where they have either failed because they have just retained control, and I would say you lost control, but you have actually received very minimum gain. Go to the right side of the x-axis. You have two categories actually. On one category, you have actually lost control, but you have actually made yourself very rich. So there is a wealth creation that has happened. There will be some limited exception category which remained in control and which also made money for both themselves and the investor. The reason I said this is primarily from two facts actually. And we can go about the length and size of the affirmative matters or the board rights. How much of the trust that the investor has been able to gain on the founder's ability to comprehend that business model. And I'll just add here that I have seen businesses where founder has not more than 8 to 10% of holding rights, but they have actually informally renounced their voting rights. That means investor says that you can vote on my favor on these following items. That's a great trust building in the business from the investor standpoint. So we are talking about two different things actually. One is that we are talking about founder control and so on, versus the investor is saying, oh, you exercise my right. That means there is a trust in the business and there is an operational flexibility being given to the founder. So there is a choice the founder always has, and he makes that decision every day. Whether I should make money or I should make a big venture. Or there is a combination of both of these, which are the exception category, where the investor has actually reposed significant confidence on this group. And if I go on the length and breadth of the shareholders' rights versus what it should have and it should not have, I think it should have limited shareholders' economic protection right. The extra situations, which is like we have seen many times, the type of transactions that any person, forget about the investors, do not appreciate. It could be related party transactions. It could be significant policy-related violations and so on. Those are the areas where I think the founder should just give away those rights, that they should not get into any of this, and investors should veto those kind of transactions. But for operational flexibility, let me actually give an example. If a business plan is drawn in consultation with the investor, the founder should be able to navigate certain ways by getting flexibility for 20%, 30%, and then there will be a discussion between the counsel, so it should be line by line or it should be en bloc and so on. Those kind of flexibility should be given to the management team, because you are also having a control on the management team's contracts, right? So I would say that the fine balance should be drawn between the x-axis and y-axis that I explained, to remain as the emperor of the business or to become the rich person. There is no success or failure in either of the category. It's a choice. So like the Chinese proverb says, one should, as a founder, should always understand the rule of the game, the stakes in it, and when you are quitting it. So the question that you asked about, should a founder be at some time be open to allow a professional CEO to come and run the company? Because the company would have gone big. The company requires different management skill set, be it marketing, be it even operational, be it multi-geography, be it navigating in a geography or a country which is tough, and you need to onboard talent at that time, and that requires a kind of giving away control to a certain extent. It should be absolutely open for founders should think about, and that balance between the investors and founders should be agreed. I would say that's where the difference between a founder being a king or a founder being an exception or a founder being a rich guy as a wealthy person for creating a large business actually remain, I would say.
It's a very interesting point, Rakesh. I would love to catch up with you on this outside after this. We need to discuss this more. So I have just time check. We have only 5 more minutes. Probably we can take some questions. Then, if not, actually I can move into the next point. Yeah, please.
Is safe in use here? Yeah. Safe instruments are also used here commonly?
In a slightly different version, because that Indian law doesn't permit to have, when the foreign investors invest into that India, we can't invest into the debt instrument. It has to be a convertible instrument. So to a certain extent, we make the changes in the Indian documents. Otherwise, safes are there.
But within domestic market, safes are very much prevalent. And you mentioned NVCA documents. So are those documents very much in use, or is there a domestic version of it also?
So we use NVCA documents regularly for all deals which are US headquartered companies and then have their business in India. So especially in SaaS, you would see most of the companies being incorporated in US, because that's the biggest market for SaaS, and US customers want companies to be in US if they want to do business with them. So that's where we see a lot of NVCA, in fact, I would not be incorrect in saying that at least all the deals that I have seen in past 8 years with US headquartered companies, they have been on NVCA. So that's the level of involvement or use of NVCA drafts.
Thank you.
We tried to adopt one of that, concepts from that NVCA documents into that Indian systems when it trying to negotiate various terms, or try to adopt, for example, that promoters' indemnities and various things like that.
But then that document is governed by
No,
foreign law.
gone by the Indian document, not that NVC document. Okay.
Hi.
Yes, Gautam.
Just wanted to ask, like we've spoken a lot about how documents are negotiated at that time and how the tension between investor rights and promoter rights. You mentioned that sometimes the comfort you give to a founder is that, listen, it's okay to give the reps warranties and indemnities because most investors will not pursue it. Given what's happened in the Indian ecosystem, let's say in the last 2 years, one is the valuation issues which you spoke about. Second is just governance issues which are coming up. So do you see a change in how you're approaching the agreements which you have now negotiated? For example, I would tell clients for the last 20 years, the inspection or audit rights, no problem, sign, no one will ever exercise it. But are you now looking at those things a little differently?
Would like to answer?
To be honest, practically nothing has changed. Like we have continued taking the same approach. Clauses have become all the more important. There has been a lot of emphasis on these clauses. But like, would exercise of inspection right become common? I don't see that happening. Would indemnity construct or reps or warranty construct become all the more cumbersome? I don't see that happening. Rather, you can say like, okay, whatever has happened in the last 2 odd years, more of an exception. Otherwise, the ecosystem's approach, or investors' approach overall has remained the same. Rather, just to add to it, if we see like how, at least in the early stage documentation, how the rights and constructs have evolved, there are hardly any warranties or indemnities that at least we are asking for. Say, for example, we have an early stage program called Surge. Coming to Rakesh's point as well, like we have a one-pager as warranties. So it's suitable for that kind of a transaction. We don't want to change our practices just because of some, 1 or 2 exceptional circumstances.
Just make a quick two-liner. I would say that even that 2 or 3 pages of rep and warranty will still cover, Gautam, that you mentioned, the different circumstances we talk about. The only important piece is that how do you implement that on a day-to-day life? Like one is the rep and warranty for what has happened in the past, but how do you conduct the business? And even if that is happening at a board level or a shareholders level, if that diligence is happening on a day-to-day practices level, I think it is still covered within the perimeter of the agreement, I would say, through covenants or so on, right? So a classic example is related party transaction. So if I'm a founder, there is no logic that I should fight with the investors' counsel saying that, oh, sorry, I can do it, but I will not come to you for an approval. I'm probably better off asking that give me flexibility to run the business operation, that I expand to, let's say, Middle East in this time frame and don't intervene because I understand the business, rather than saying, sorry, allow me to do a related party transaction. So the essence of this is that which are the ones that should be there and which should not be there is primarily from the perspective of how to expand the business in a logical, opportunity-based business and a robust business model, rather than any personal or preferential basis that you want to do for own benefit. Because this is where the whole control part will come into play.
Exactly. Any more questions? Please.
Sir, I have a question from Rakesh sir. Sir, because you are working in a general counsel in Oyo. Sir, nowadays, because there are a lot of the startup are going and they faced, and some after the growing, and they faced a issue like investor funding, and they take a lot of the money, like 20% equity, 30% equity, and after they are expanding business, they take a lot of issue for expanding and financial issue. So how can startups and founding startups, seed funding startups protect this types of funding and investor?
So basically you are saying how, let's say an angel will get protected from a person who is actually running an early stage business, right? Yeah. I think it is important to understand that's a very valid point, because even the angels are not going to just throw away money for somebody, right? I think idea that one is betting on, the person who they're betting on, the cultural mindset of the person. Because what happens is, most of the time, for example, for a founder, it is the business opportunity, it is the management team that you're putting in place, it's the culture that you have put in place for the organization. And actually, I can tell you that that culture is almost like inherited by everybody else in the organization. And most of the time, we have seen in this world that that founder becomes the synonymous face of the brand. So that financial and operating diligence on a day-to-day basis for that founder to implement in the company is going to be super important. And that's where the investor should look at when they're putting money. And I don't think rep and warranty will solve this. But that assessment at that time, that am I putting the money on the right person with the right cultural value and the right business opportunity, right business model, with somebody who will use this diligently, is going to be most important.
Thank you all that we have already exceeded our time. So thanks for it.